call, live from the CNBC TV 18 headquarters in Mumbai.
Good morning. Welcome to Bazaar Morning Call. I'm Lata and Anuj and Sonia joining me from their homes. Well, what do we have here? A huge seesaw market. Risk off yesterday and risk on since perhaps about noon on the US indices. It's climbed. The Dow was 0.6 up overnight in the markets and another 2% up Dow futures. So that gives us a huge 3% head start, and that's what the Asian markets are indicating, a huge gap up opening, and that's what the SGX Nifty is indicating. Okay, so really tough to predict. We are just following the coattails of what the US markets are doing. It's a liquidity-driven market and we shouldn't be surprised. But I want to point out to a couple of things. The banks and the NBFCs were the ones that were beaten down the most yesterday. So chances are today you're going to see a very sharp recovery over there. I'll leave that to Anuj. But for me, an important point that investors will take note of, not traders, investors for sure, is that Lakshmi Vilas Bank is getting a marquee investor probably. I mean, Clicks Capital and Clicks Finance is no pushover. It's a Pramod Bhasin-backed company, and Pramod Bhasin has, one of India's best entrepreneurs, best technocrats. They were backed by Aeon Capital. So for me, it's big excitement. I always thought Indian private banks are a great positive proposition, and I was a bit surprised at not seeing Yes Bank get capital, but of course Yes had a huge hole. This one is clearly very, very positive news for me. Good morning, Anuj.
Good morning, Lata. You know what? Yesterday I was doing YouTube live. My thought process was that the market's priced in a lot of negatives and could move on. Little did we know that the US market will have this kind of stunning last hour recovery. Look, when the Fed is providing so much liquidity, it's tough to fight for the bears. You could argue about the economy, but the only thing left for the Fed perhaps now is to directly go out and buy stocks. Now that they're unveiling another corporate bond buying program of $250 billion. So there's a lot of money which is chasing risky assets, and most equity markets are taking cue from that, and they have surged. What do we have for us is that yesterday we had a bit of an inside day. The high and low were both within the previous range, and now the SGX Nifty is indicating that we will start somewhere around Friday's high of 10,000. Now, this market essentially has been in a range of between 20 to 100-day moving average, 95.50 on the way down, 10,200 on the way up, and within that, it's giving you wild swings. It's one thing to say that this is a market which is in this range and which is following Wall Street cues. It's completely another thing to trade it. For example, it would have been almost impossible yesterday to trade this market. Now, today, if you have a 200-point gap up, do you buy it? That's the call that you need to take. The Bank Nifty is the one which you could focus on, because that's the one where you've seen some shorting, and perhaps that's the one area where you could have some short covering. Not just banks, but I think select NBFCs as well could see some short covering. Having said that, I just want to make a point that this is a market in which the FI selling is back and back big time in cash market. Now, this is of course before yesterday's Fed announcement, so things could still change, but yesterday FI sold about 3,000 crores. And the other thing is that this mid-cap rally that I've been talking about, while it continues, the quality of the mid-cap rally has now started to deteriorate quite a bit. There's one parameter that I look at, the Nifty, the junior, the mid-cap and the small cap. The Nifty is up 2.4, the junior is up 3%, mid-cap is up 6.8%, and the small cap index is up 10% this month. I think that's perhaps a reason that you get slightly cautious of the kind of rally that you've seen in a lot of stocks. You see the top gainers of this month won't give you a comforting sign, but of course that doesn't mean that the market stops rising, because there's just this global liquidity which is pushing asset prices. Sonia, good morning.
Hi, good morning, Anuj. In fact, that was my question to you. I mean, if you look at the headline index, the Nifty has seen, the third straight day of a decline. And we've seen FIs continue to sell, right? So yesterday as well, you saw almost 3,000 crores of selling from FIs. Of course, domestic institutions bought about 1,070 crores or so. But my question to you is, given the kind of run-up that we've already seen and a couple of days where the market is sort of deciding which way to go, you reckon that the rally has seen, is it just a roadblock or is it a full stop here for this rally that started, say, at the end of March?
I think it was a pause. It was never a halt, Sonia. And I've been talking about this unfinished business at 10,400. But look, the point again is that this is a market which is now making our opinions. 2 days back, you could have easily said that the market's going back towards 8,800. Today, the chatter is the market going back and testing the June highs because that's what liquidity does. It turns on a dime. Just till about 2 days back, the entire chatter was what was happening in the US with the second wave. All of a sudden, Fed comes out and says they're going to buy $250 billion of corporate bonds. What second wave? Nobody cares because there's easy money which is there to chase asset prices. So this is again one of those markets in which you have to respect the liquidity, but at the same time be careful of what you're doing. Perhaps not a portfolio market, a trading market. Don't fight the liquidity, but be careful about the kind of stocks that you're buying, especially if you're buying in your portfolios.
Yeah. Anuj, doesn't this month remind you of the year 2017? Remember 2017? Small caps 60% higher, mid caps 40% higher. Reminds you of that, doesn't it?
Yeah. No, that was a completely different year, Lata. This year, what has happened is that at least some mid caps and small caps have a valuation comfort. But I think this month has been crazy. The way, I mean, just look at yesterday's top gainers and tell me if you're confident about those stocks and whether I think it was Warren Buffett or someone who said that if you buy stocks with the knowledge that they will shut the market for 10 years, you'll be okay. Look at yesterday's top gainers and tell me if you had them on your portfolio and the market is shut for next 10 years, will you be happy? I think the answer would be
I didn't have that comfort even in 2017 with the guys that rose the most, the NBFCs. Ultimately, they were the ones who pulled us down. So, when liquidity comes, even those that are good rise more than they ought to. But, well, that's the nature of the market. And as you pointed out, that's the nature of liquidity as well. It can take all boats up, but you should know which boat to get into and when to get out and when to book your profit. Not my cup, of course. We are all mutual fund investors. We are all SIP investors. All right, let's get to equity advice in the morning. And we have this one from a marquee watcher of the Indian skies. Chris Wood of Jefferies says, the evidence of a second wave of COVID-19 is not yet compelling, but there is enough to justify the renewed risk-off action. While China can be relied upon to manage the renewed outbreak effectively, from a Western standpoint, there continues to be a remarkable divergence between Western Europe and America. That reflects the reality that European governments, Britain excluded, have managed the health crisis in a much more intelligent, systematic fashion. Still, as these economies reopen, the risk of a renewed surge will rise. So that's a risk of opinion. Sonia.
Okay, a risk of opinion. There's another one actually coming through from Jonathan Garner of Morgan Stanley. He says superior developed market stimulus and adverse emerging market COVID-19 outcomes ex-North Asia keep emerging market equities lagging. Morgan Stanley is overweight on Japan and China A shares, but they upgrade Indonesia and Greece alongside overweights in Singapore, China, India, Russia and Brazil. They see a tactical window for cyclical/value stocks. So contradictory opinions coming in this morning, Lata, but I guess that's what makes the market.
He's saying it's a tactical window. He's obviously not saying that this is a long-term fundamental call. There's a tactical window, which is what liquidity always provides. Well, let's get you money market views. Bhaskar Panda of HDFC Bank says the Fed came to the rescue of the markets as it announced a further corporate bond purchase program and kept the liquidity window steady. The optimism in the US could trigger a bit of risk rally in Asia, including India. As a result, USD-INR pair is expected to start the day below 76 and trade in a range between 75.80 to 76 for the day. I might add that the trade deficit data, lowest in my reporting history, just $3 billion, should also be a positive.
Okay, well, on the bonds, Bhaskar Panda says the Indian benchmark bond yields have been range bound and will continue to remain in the same mode. He expects the 10-year benchmark yield to trade within 5.75 to 5.80% for today.
Okay, let's talk about the global cues then. That's of course going to be the key talking point. Here's Mangalam with the world view.